This is Alan Bush with ADMIS with the daily financial forecast for Tuesday, October 27th. Starting out in the stock index futures, we are seeing prices a little bit lower. We did have a series of economic reports today coming in, mixed, but maybe a little bit on the weaker side. Looks like much of the trade is an evening up session in advance of the Fed statement tomorrow after the two-day Federal Open Market Committee meeting. Right now, there is a very limited chance, only about a 5% chance, according to financial futures markets, that the Fed will be able to raise interest rates at the two-day meeting. Of course, that's a two-day meeting starting today, concluding tomorrow. And we will get a statement from the Fed at approximately 1 o'clock Central Time tomorrow afternoon. Longer term, we feel that interest rates will remain low and that the Fed will be very slow to raise rates, if they can raise rates at all next year. Other central banks around the world that are not talking hawkish, that are actually in an easing mode, such as the European Central Bank, the Bank of Japan, and the People's Bank of China, they will probably add more stimulus, which is the dominant influence on stock indices that will likely take all of the major indices into new historical highs next year. Now, moving over to the foreign currencies, seeing the dollar index basically just steady. Much of the trade in the currencies is evening up ahead of the Fed statement tomorrow. A little pressure in the British pound after UK third quarter GDP coming in only up 0.5%. That compares to the estimate of up 0.6%. Also, with crude oil prices down, that's putting a little pressure on the commodity currencies, the Canadian dollar and the Australian dollar. But longer term, getting back to the dollar index, we feel that since the Fed cannot raise rates, that will undermine the dollar index over the longer term. So I think that is the trend that will persist likely well into next year. That is lower prices for the dollar index. Now, moving over to the interest rate futures markets, prices higher across the board, with most of the gains taking place at the long end of the curve in the 30-year bonds. Once again, the dominant influence here, I feel, is the Fed in a position not to raise rates anytime soon, plus other central banks likely to be more accommodative, all of which should support the interest rate futures markets, especially at the long end. So longer term, I would look for higher prices in the 30-year bonds, and the bonds should be the leader to the upside. So good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.